Hey everyone, and welcome to our deep dive today. You asked us to unpack The Little Book of Common Sense Investing
Oh,
by John C. Bogle,
mm,
founder of Vanguard and creator of the first index mutual fund.
a classic.
It's considered a classic guide to building wealth.
Definitely.
So let's dive in and see what wisdom we can extract.
Yeah, sounds good.
This book definitely stands the test of time.
It does.
Bogle really emphasizes a straightforward, long-term approach
Yeah,
to investing, which is as relevant today as it was back then.
absolutely.
Right off the bat, Bogle uses this really clever parable
Okay.
about the Gottschalks family in Chapter 1. Imagine a family that owns 100% of a successful business.
Okay.
They basically own the entire stock market.
Mm.
But instead of just enjoying their wealth, they become obsessed with outdoing each other.
Oh, wow.
They start hiring all these advisors, brokers, consultants, constantly buying and selling shares amongst themselves
Oh, so
for the business.
they're just churning it. Yeah.
And what's brilliant about this parable is how it highlights the impact of costs.
Yeah.
Every transaction, every bit of advice,
Mm-hmm.
every fee chips away at their ownership of the business,
Right.
ultimately reducing their overall wealth.
Mm.
It's a perfect analogy for the way costs can eat away at your investment returns in the real world.
Absolutely.
Exactly. It's like they're slowly but surely giving away their wealth
Yeah.
to these helpers who claim to have some secret formula for outperformance.
Right.
Bogle even quotes Warren Buffett in this chapter,
Yeah.
who adds a fourth law of motion for investors.
Okay.
He says, for investors as a whole, returns decrease as motion increases.
I like that.
So the more you trade, the more you spend on fees,
Mm-hmm.
and ultimately the less you end up with.
Right. Makes sense.
And this parable really sets the stage for one of Bogle's central arguments,
Okay.
that trying to beat the market is in fact a loser's game.
Interesting.
He explains that for every winner in the stock market, there has to be a loser, before costs are even factored in. It's essentially a zero-sum game.
Okay.
That makes a lot of sense. But wouldn't that mean that at best we can only hope to match the market's returns?
Well, that's where things get interesting. Bogle argues that by understanding the nature of market returns,
Mm-hmm.
you can actually maximize your gains.
Good.
He breaks down returns into two components: investment return and speculative return.
Right.
Investment return comes from dividends
Mm-hmm.
and the long-term earnings growth of companies. Speculative return, on the other hand, is driven by changes in the price-to-earnings ratio,
Okay.
which is essentially how much investors are willing to pay for a dollar of earnings.
Okay, so that's where the speculative part comes in.
Yeah.
People are speculating about the future value of companies.
Exactly. And this speculative return is highly volatile,
Okay.
influenced by emotions, news, and all sorts of unpredictable factors.
Yeah?
Bogle shows this using a fascinating chart,
Okay.
Exhibit 2.1, where you can see how speculative return jumps around all over the place, often reversing course dramatically. The key takeaway is that these short-term fluctuations are essentially noise in the long run.
Okay.
The real driver of long-term gains is the steady, consistent growth of investment return, the dividends and earnings growth of companies.
So if we're playing the long game, we should be focusing on those fundamental factors that drive business growth, rather than trying to predict the unpredictable swings of speculative return.
Precisely. Bogle's insight here is that by simply owning the entire stock market,
Okay.
you capture both the investment return and the speculative return. He's not suggesting you go out and buy shares of every single company listed on the stock exchange, though.
That would be a logistical nightmare.
It would. That's where index funds come in.
Okay.
Bogle pioneered the first index mutual fund, and they're the cornerstone of his entire investment philosophy. An index fund is like a basket of stocks
Okay.
that tracks a specific market index, like the S&P 500
Yeah.
or the Dow Jones Wilshire Total Stock Market Index.
So instead of trying to pick individual stocks,
Mhm.
you're essentially buying a tiny slice of all the companies in the index.
Exactly. And the beauty of this approach is that you're guaranteed to capture the market's return, whatever that may be. You're not trying to outsmart anyone or predict the future. You're simply riding the wave of overall market growth.
I like it.
Now, the S&P 500 is made up of 500 of the largest U.S. companies.
Okay.
And some people wonder if that's too narrow a focus.
Right.
But Bogle points out that the total stock market index, which includes thousands of stocks, actually has near identical returns to the S&P 500 over the long term,
Okay.
which he illustrates in Exhibit 3.2. So the key takeaway is that owning a broad market index fund is a simple and effective way to participate in the growth of the stock market as a whole.
It's starting to sound like trying to beat the market is more trouble than it's worth.
Yeah.
You mentioned earlier it's a loser's game, and I'm curious to learn more about why Bogle believes that so strongly.
Well, he dives deeper into the loser's game by explaining what he calls the relentless rules of humble arithmetic.
Okay.
This is where things get a little more technical, but the core idea is that costs, no matter how small they seem, have a massive impact on your returns over time because of the way compounding works.
Right.
Think back to the Gottfried's family parable. It wasn't just one big expense that eroded their wealth. It was the constant drip, drip, drip of fees and transaction costs.
So even a seemingly small fee, when compounded over decades, can end up costing you a significant chunk of your potential return.
Exactly. Bogle breaks down the various costs involved in investing, including expense ratios, which are the annual fees charged by mutual funds, sales charges or loads, which are upfront fees you pay when you buy or sell certain funds, and the often overlooked cost of portfolio turnover.
Portfolio turnover, what's that all about?
Well, every time a fund manager buys or sells a stock within a fund, it incurs trading costs, which are ultimately passed on to the investors in the form of lower returns. Funds with high turnover rates, meaning they're constantly buying and selling stocks, can rack up significant trading costs, eating away at your profits. Bogle illustrates the devastating impact of costs over a lifetime of investing in Chapter 4. He uses a hypothetical example where an investor puts up 100% of the capital and takes 100% of the risk. But because of all these costs, they only end up with about 30% of the market's return over a 50-year period. It's a stark reminder that the more you pay in fees, the less you keep of your hard-earned gains. He shows this visually in Exhibits 4.1 and 4.2, and it really drives home the point.
Wow, that's sobering. It sounds like those costs can really make or break your investment success.
They really can.
But how do we even know if the returns funds report are accurate?
That's another great point. Bogle tackles this head-on in a chapter he calls The Grand Illusion. He reveals that the returns mutual funds report often don't reflect what investors actually earn.
Wait, what? How is that possible?
Well, it comes down to investor behavior. Many investors chase performance, meaning they pile into funds that have done well recently, only to get burned when those funds inevitably underperform. This tendency to buy high and sell low, driven by emotions like fear and greed, actually reduces their overall returns.
So it's not just the fees that matter, it's also our own actions that can sabotage our investment success.
Precisely. Bogle shows an example of this from the 1990s bull market, where the average equity fund investor actually earned significantly less than the average equity fund itself, even before accounting for inflation.
Wow.
He shows this visually in Exhibits 5.1 and 5.2. It's a powerful illustration of how emotions can lead to poor investment decisions and diminished returns.
This is really eye-opening. It seems like there's a lot more to successful investing than simply picking the hot fund of the moment. We need to understand the underlying mechanics of the market, the impact of costs, and the importance of controlling our own behavior.
You got it. And that's just the tip of the iceberg. Bogle goes on to unpack even more common misconceptions and pitfalls that investors face, especially when it comes to actively managed funds.
Well, I can't wait to dive into those. But I think we've covered a lot of ground for now.
Agreed. Let's take a moment for you to absorb all this before we continue exploring the world of common sense investing with Bogle.
Okay, so we've established that trying to beat the market through active management is a tough game.
It is.
And even when funds do well, the returns reported don't necessarily match what investors actually earn. It's all starting to paint a pretty bleak picture.
It can seem that way if you're approaching investing from the wrong perspective. But remember, Bogle isn't trying to discourage you from investing. He's trying to empower you to invest smarter. He's laying out a path to building wealth that's based on sound principles and a realistic understanding of how markets work.
That's reassuring to hear. So if we're not trying to chase performance and pick winning funds, what should we be doing? What does Bogle recommend for the everyday investor who wants to grow their wealth over the long term?
He actually dedicates a significant portion of the book to outlining specific investment strategies. And it all boils down to this: simplicity. He indicates for building a portfolio primarily composed of low-cost, broadly diversified index funds.
Index funds again. It seems like they're the answer to everything.
Well, they are a powerful tool for capturing market returns without getting caught up in the complexity and high costs of active management.
Okay.
Now, some people might hear index funds and think, that sounds boring. I want to be more actively involved in managing my money.
I can understand that. It's exciting to think about picking the next Apple or Amazon.
Bogle acknowledges that. And he even suggests setting aside a small portion of your portfolio,
Okay.
maybe 5%, for what he calls funny money.
Funny money? Okay.
This is your play money, the money you can use to experiment with individual stocks, try different strategies, or chase those exciting investment trends.
So it's like giving yourself permission to have a little fun with investing without putting your serious savings at risk.
Exactly. It's about finding that balance between discipline and experimentation.
Okay.
But when it comes to the vast majority of your investments, what Bogle calls your serious money.
Serious money.
Okay. He's adamant that you should stick to a strategy that's proven to work over the long term.
Which brings us back to index funds.
Right. He even quotes Warren Buffett again in this section,
Okay.
who says, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals.
Wow, that's quite an endorsement.
High praise from the Oracle of Omaha himself.
So index funds for the serious money. A little play of money for the funny money. Got it.
Yeah.
But what does that actually look like in practice?
Yeah.
What specific index funds does Bogle recommend?
He suggests starting with a core allocation to both stocks and bonds,
Okay.
with the exact mix depending on your individual risk tolerance, time horizon, and financial goals. He generally recommends a higher allocation to stocks for younger investors, as they have more time to recover from market fluctuations.
Makes sense. You wouldn't want someone nearing retirement to have all their money in stocks when the market takes a sudden downturn.
Exactly. But regardless of your age or risk tolerance, diversification is key. Bogle emphasizes the importance of spreading your investments across different asset classes like stocks and bonds, but also within those classes. That's one of the biggest advantages of index funds. They give you instant diversification by owning a tiny piece of hundreds or even thousands of companies.
So, for example, instead of trying to pick the next winning tech stock, I could just buy a broad market index fund that holds all the major tech companies.
Precisely. That way, even if one company stumbles, your entire portfolio isn't wiped out.
Right.
Now, while Bogle advocates for a simple all-U.S. stock market, an all-U.S. bond market approach as a solid foundation, he does offer a few variations for those who want to fine-tune their portfolio.
I'm curious about those. What kind of variations is he talking about?
Well, one common variation is to add some international exposure. While U.S. companies do have global operations, allocating a portion of your stock portfolio, maybe 20% to 40%, to international stocks can further diversify your holdings. He recommends sticking with low-cost, broadly diversified index funds for this as well.
That makes sense. It's all about spreading your risk across different regions of the world.
Right.
What other variations does he suggest?
He also discusses different styles of stocks, like value stocks or small-cap stocks. These styles have historically outperformed the broader market over long periods, but there's no guarantee they'll continue to do so in the future. So he suggests a balanced approach, keeping the majority of your stock allocation in a broad market index fund, and then adding smaller portions, maybe 5% or 10% each, to value and small cap index funds.
So you're essentially tilting your portfolio slightly towards these styles without going all in on any one strategy.
Exactly. It's all about finding that sweet spot between diversification and potential outperformance.
That covers stocks. What about bonds? What's Bogle's take on those?
He recommends an all-U.S. bond market portfolio as the foundation for your bond allocation. This type of fund gives you exposure to a wide variety of government, corporate and mortgage-backed bonds, typically with an intermediate term maturity, meaning they mature in about 5 to 10 years.
So it's like the bond equivalent of the total stock market index fund. You get broad exposure to the entire bond market in one simple package.
You got it. But he also recognizes that investors have different needs and preferences. When it comes to bonds, some might need more income from their bonds, while others might prioritize stability. He suggests exploring different types of bond index funds, such as short-term, intermediate-term, and long-term bonds, to create a portfolio that aligns with your individual goals and risk tolerance.
He even mentions inflation-protected bonds, also known as TPS, which can help protect your portfolio against rising prices.
Right. Those can be particularly valuable in tax-deferred accounts, where you don't have to worry about the tax implications of their fluctuating principal values.
What about those all-in-one balanced index funds that I've heard about? The ones that hold both stocks and bonds in a preset allocation.
Bogle is a big fan of those. He calls them funds for the forgetful.
Funds for the forgetful. I like that.
Because they handle both asset allocation and rebalancing automatically, taking a lot of the guesswork out of investing. They're especially popular for retirement accounts and can be a great option for investors who value simplicity and low costs.
I think I've even seen some target date retirement funds that gradually shift their allocation from stocks to bonds as you get closer to retirement.
Exactly. Those are super convenient and can take a lot of stress. Out of managing your retirement savings, you basically just pick the fund that aligns with your expected retirement date, and it does the rest for you.
Wow, there are so many different types of index funds these days.
There are.
It's incredible how far they've come since Bogle launched the first one back in the 70s.
It's a testament to the power of his ideas. They've truly revolutionized the way millions of people invest.
It all boils down to keeping costs low, staying diversified, being patient, and avoiding the temptation to outsmart the market.
You nailed it. Bogle's approach is all about common sense discipline and a long-term perspective.
Now, he does acknowledge that even the most disciplined investors might feel tempted to stray from the index fund path.
Right, especially when they hear stories about people striking it rich with individual stocks or risky strategies.
Right.
So he offers one final piece of advice for anyone struggling with those temptations. He calls it the ultimate common sense test.
Ooh, I'm all ears. Tell me more about this ultimate test.
He calls it the mirror test before you make any investment decision, especially one that deviates from your core index fund strategy. Bogle says you should take a long, hard look in the mirror and ask yourself 3 crucial questions.
Okay, I'm ready for some self-reflection. What's the first question?
The first question is, what do you bring to this party? He's not talking about your charming personality here. He wants you to honestly assess your knowledge, your experience, and your temperament as an investor.
So it's all about being self-aware. And understanding our own strengths and weaknesses.
Exactly. If you have decades of experience in financial markets, a deep understanding of valuation techniques, and the emotional discipline of a Buddhist monk, well, maybe you have a shot at consistently beating the market.
But for most of us mere mortals, that's not the case.
Right. Most of us are busy with our lives. We have limited financial expertise. And let's be honest, we're prone to letting our emotions influence our decisions, especially when it comes to money.
Fear and greed can be powerful motivators, that's for sure.
They are.
Okay, so that's question 1. What's the second question we should be asking ourselves in the mirror?
The second question is, what's the game plan? Bogle wants you to clearly define your investment strategy. Before you even think about buying or selling anything, what are your financial goals? What's your time horizon? How much risk are you truly comfortable taking?
It's like creating a roadmap for your investments, so you don't get lost along the way.
Precisely. And this is where a lot of investors go astray. They jump into the market without a clear plan, chasing hot tips, reacting to headlines, and letting their emotions drive their decisions.
Which often leads to buying high and selling low, which is the opposite of what you want to do.
Exactly. A well-defined strategy helps you stay focused, avoid impulsive moves, and stick to your plan, even when the market gets turbulent.
Okay, 2 questions down, 1 to go. What's the final and perhaps most important question in Bogle's mirror test?
The third question is, what's the likely outcome? Bogle wants you to be brutally honest with yourself about the potential consequences of your actions, both positive and negative.
So it's not just about dreaming big, it's also about acknowledging the risks involved.
Absolutely. Too many investors focus solely on the potential rewards, imagining themselves retiring early on a private island. But they fail to consider the possibility of significant losses.
It's like betting your entire savings on a single hand of poker. You might win big, but you also risk losing everything.
That's a great analogy. Bogle's mirror test is all about confronting reality, making informed decisions and not letting emotions or wishful thinking cloud your judgment.
So before we buy that hot stock tip from our overly confident coworker, or put all our money into the latest investment fad, we should take a long, hard look in the mirror and answer those 3 questions honestly.
Precisely. It's such a simple yet powerful exercise.
I love it. It can help you avoid those costly mistakes and stay on track to reach your financial goals.
Bogle really drives home the point that while we can't control what the market does, we can control our own behavior and the decisions we make.
Absolutely. And he wraps up the book with this powerful reminder. Don't let the tyranny of compounding costs overwhelm the magic of compounding returns.
That's such a great quote. It really captures the essence of his message.
It does.
Bogle isn't saying that investing is easy or risk-free, but he is saying that by following a few common-sense principles, you can significantly increase your odds of success.
Well, there you have it, folks. Our deep dive into John C. Bogle's The Little Book of Common Sense Investing.
It's a good one.
We've covered a lot of ground today, from the pitfalls of active management to the power of index funds, and of course Bogle's timeless wisdom about keeping costs low, staying diversified, and being patient.
Right. We hope you found this deep dive insightful and helpful as you navigate your own investment journey.
For more such content, go to our channel, Pages and Perspectives. Don't forget to like, share, and subscribe, and press the bell icon to get the latest updates. Thank you for joining us.